In today's video, I will be describing what loans are, how they work, and why they're important sources of funding in a variety of situations. A loan is an agreement to exchange money or material goods today, known as the principal, for either one or a series of future payments from another party, which usually includes interest. Loans are either a one-time exchange, such as an auto loan, or are open-ended, such as with credit cards. In the case of a one-time exchange, money or goods are given to the borrower up front in exchange for regular and periodic repayments over the life of the loan. How long the loan will last, how many payments are to be made, and the amount of each payment are collectively known as the terms of the loan and are generally agreed upon, usually in writing, before any money or goods change hands. Loans can be made between any two parties. The government loans money to individuals with a federal student loan. Individuals loan money to governments with treasury securities. Businesses loan money from one corporation to another using a business loan. And an individual can loan money to a corporation with a corporate bond. When one individual lends money to another, we call that a personal loan. These are just a few of many different types of loans that are out there. In the eyes of the lender, the loan is an asset because it represents a series of payments to be received in the future. Therefore, we can consider the loan to be a financial security. It can be sold to another person or institution, and often is. In fact, corporate bonds and bank loans are popular financial instruments that are often considered for inclusion in a well-diversified investment portfolio. Interest is probably the most important aspect of a loan and is usually expressed as a percentage of the loan's principal and called the interest rate. In a sense, the interest rate can be thought of as the amount of money that will compensate the lender for borrowing their asset or the principal. If you borrow money from someone, they no longer can use that money. So, in order to convince a lender to give their money, a borrower must agree to pay it back in full, plus a little in interest. That extra interest is how the lender can profit from lending. The interest rate is determined by a variety of factors, and one of the most important of these is the creditworthiness of the borrower. That is, how likely is the borrower to repay the principal and interest? Will they make their payments on time? Will they fail to pay the full amount and default? A borrower with a high likelihood to repay is thought of as creditworthy and has a higher credit score. A creditworthy borrower, if all else is held equal, will typically be offered a lower interest rate than a borrower with poor credit history and a low credit score. Interest rates are given in the terms of a loan and must be agreed upon before the loan goes into effect. Note, however, that interest rates can change over the life of the loan if the loan has what's known as a variable or floating interest rate. Fixed rates, on the other hand, are static and do not change over the course of the loan. For more about fixed versus floating interest rates, take a look at our video on that topic. Interest might also depend on the length of the loan. Longer loans will typically require a borrower to pay more in interest since the lender will not be able to use their money or principal for a longer period of time. Finally, the supply and demand of money can have a strong effect on the interest rate. If there are fewer borrowers and more lenders, that is, if there's a higher supply of money than there is demand for it, the lenders will be forced to lower their interest rates to remain competitive with one another. Conversely, if there is a high demand for borrowed money, i.e. lots of borrowers and fewer lenders, lenders are able to charge a little bit more in interest. Some types of loans use physical assets, like a house or a car, as collateral. If the borrower is unable to make interest and principal payments on a loan with collateral, the lender can take the asset instead of the money. Usually, if the lender is a bank, they'll try to sell that asset on the open market in order to recover their lost money. Collateralized loans, also known as secured loans, usually have lower interest rates than uncollateralized or unsecured loans, since those collateralized loans are less risky for the lender. A mortgage is an example of a collateralized loan, since the loan is secured by the home. If the borrower cannot pay their mortgage payments, the bank can foreclose on the home and sell it. Since a loan is a legal contract, the borrower is obliged to pay the loan on time. But what happens if a borrower cannot pay? Well, the borrower defaults on the loan. If the loan was secured by collateral, as we just outlined, the lender would legally seize it. But in the case of an unsecured loan, the lender has no recourse. The borrower, however, faces strong negative consequences. Primarily, their credit score is severely negatively impacted, which impairs their ability to apply for new loans in the future. If a borrower continues to default on their obligations, they may be forced to declare bankruptcy, which is a legal proceeding in which borrowers' assets are seized and sold in order to pay off debts. Loans are a serious and binding contract with real consequences in the event of default. However, if managed properly, they allow borrowers the ability to finance assets that they otherwise would be unable to afford. Without loans, many people would not be able to buy homes or cars, many would be unable to attend higher education, and many businesses would not be able to expand their operations. Loans make up a very important part of the economy.